last week we went over a lot of information. Right? Does anybody have any questions about anything we talked about last week? Nobody got any questions. Anybody got any questions? Nobody? Anybody do anything?
I wasn't here last week, so I'd like to know what you spoke about.
Last week we just really got into a lot of fundamentals. It was a mixed bag of topics. And we just kind of had a conversation, so we just kind of free flowed and it just into different areas. And I don't have the list that was written down, so I really couldn't go over it. We just kind of free flowed on different topics, talking about fundamentals and how some of those fundamentals affected the market, and gave you a glimpse into what type of trading behavior was potentially going to happen. Now, the thing about those fundamentals is so much of it. It's so much news. You're going to have to really understand what types of news affect what types of things, what types of commodities, and what type of assets, right? So we kind of got into that a little bit. We got into the size, got into how to determine a potential impact of fundamentals of news events based on the size of the thing that's being reported. For example, I'm just go over a quick rehash for the people who may have forgotten or who were not here last week. We're not gonna go too deep into this because I don't want to get the time of doing that, right? But to determine the way I determine, what news is so impactful to my trading is about the size of the thing that's reporting the news, or the size of the item of the news, right? And the scenario that we gave last week was we just came out of earnings season with companies, earning reports, earnings per shares, things like that, right? Corporate news was coming out. Right? This is before all this other stuff just started going crazy. So by itself, in and of itself, the corporate earnings are usually good news, bad news scenarios. But it's just a company, and that company sits inside of a country, right? So if the company has good earnings, but then the Federal Reserve comes out and has a bad interest rate news, or if the country itself has bad news, then that country's news tends to overshadow the company's news because the country is bigger than the company. Once we go beyond the country, then we have world news, right? The big thing in the news right now is Corona, right? And they're talking about Corona. Let's back away from Corona for a minute. Absent of Corona, they were talking about recession, right? It's an easier thing to grasp, right? So the recession news is bigger than a company's positive or negative interest rate news, right? Because the world in the recession is bigger than that country is, having positive news, which is bigger than the company having positive or negative news. So the way I determine what the potential impact of something is by the size of the thing I'm evaluating. Make any sense? I'm assuming that makes sense.
It's like the way Just trades and market structure. You have bigger structures that can be broken and minor structure that would be respected, but overall the bigger structure will be respected more than the minor. So you're saying the overall world news will be more powerful than the company's overall structure. Like Apple did really well, but overall the company is doing horrible. So therefore, Apple really doesn't matter.
So that's kind of what we went over last week. Right, and I don't remember everything we went over because we went over so much. But that was really one of the big things that we went over.
I know what you could go over. You can go over kind of like what we were talking about Saturday, not too in detail, but kind of how like the macroeconomics that surrounds the macroeconomics that everybody should know, like generally that will affect. Oh my God, somebody's still blurring on my screen. the macroeconomics that literally will affect everything, and then going in detail to understanding, okay, well, if you trade this particular currency, then understanding that. But you don't have to go into like the currency, but just the basic macroeconomics that everybody should understand if they're a trader.
All right. We got into, I guess we can get into it briefly again here. We got into understanding what the commodity was that each country either needs or has to sell or has to import or export, right? So when you start talking about example, I think the example that we used last week was oil. When you start talking about something like oil coming out of the Middle East, you have to look at the oil producing countries, right? And we got into OPEC. So when there's trouble in the Middle East, you can expect oil to respond negatively. When there's a trade war going on, like it is right now, you can expect oil to respond negatively. When there's blue skies and rainbows and everything is hunky-dory, you can expect oil prices to rise. Summer months is a big selling season, travel season, right? So you can typically expect there to be higher prices in the summer for oil. You can also expect as you get closer to the weekends, the price of oil and the price of gas goes up because people are going to be off traveling for the weekend. So usually when you fill up on gas, for example, middle part of the week, Tuesday, maybe Thursday, Tuesday, Wednesday, Thursday, is a better time to fill up on gas because it's usually cheaper than it is on Friday, Saturday, Sunday. People going back to work and people traveling for the weekend. So when you start to understand what affects a thing and what affects a country, then you start to hone in on the news events that you start to hone in on news events that are impactful to that country because they trade that particular asset that you're trading, which in this case is oil. But if you were looking at, lean hogs, where you have to look at what countries trade lean hogs, what country need hogs, what country exports hogs. You're looking at wood or steel, what countries trade those, and how does the trade wars and how does the tariffs impact those things, right? So that's kind of what we got into last week. And I don't want to have a complete rehash of that because we'll just be dumbing down on the same things we talked about already. But for those people who were not here, or you may not have caught all of that, that's kind of where we were last week. What I want to know is, when you guys left last week and you started looking around for fundamentals, what did you see and how did you see it impact the market? We're going to have a conversation. I don't want to sit here and just rattle off websites and numbers and statistics and things like that. What did you guys see that you thought you may either had questions about or something that was maybe confusing or you needed more information about?
And my psychology just get messed up because when I watch the amount of ads I get that I didn't need to get, I said, boy, let me just delete them by stuff here.
Are you talking to me? Because I can't hardly hear what you're saying. Oh, you weren't talking to me. All right. Anyway. Okay. Nobody has questions. All right. Okay. Let me tell you what I see. And I haven't really looked into the market this week, right? Because I've been busy doing other things. But kind of what I see that's happening right now, and what you all should be paying attention to, is how this market and the velocity of this market parallels the markets that happened during the Great Depression. This is going to be the big takeaway, right? This economy that we have, if anybody has noticed, has been on what they call the longest bull run in history, the greatest of all time, blah, 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 right? But the market that we have is overheated, has been for a very, very long time, and they've just been propping it up. So some of the things that happening now was going to happen whether we had Corona or some other catalyst was going to come into play, because the market was 60%. The stock market was about 60% bigger than the entire U.S. economy, and that should not really be the case, right? You don't really want a stock market. How can all the companies and all the money coming in through these corporations and these bonds and all those stuff be bigger than all the economics of an entire country? That's really not possible. It really should not be possible. So this correction or this bear shift was bound to happen. So when you look at the news events, and if you start bringing up the news events for me, Jessica, it doesn't really matter what kind of news event it is, we can analyze it. But if you look at what's happening in the news, they've been talking about corona, right? More cases are popping up in New York. More cases are popping up in California. More cases are popping up in Italy, right? When you all see this type of news, it should spark something in your mind that says there's going to be an opportunity here to trade this news. Like I'm talking to myself. But
just knew when we trying to soak a ball, you got
yeah, I'm here, bro.
like I'm in a room by myself, man. Somebody say something, but okay.
No, we here. We're taking notes.
All right. But it should spark something. It should spark something in you and say, okay, all this stuff happened over the weekend when the markets were closed. What do I expect this thing to do on Monday or Sunday night when the futures market opens, right? Or the session opens on Sunday night, going into the Monday morning session. What do I expect this happening? Now, when you see this thing that was happening over the weekend, you heard a lot of things. You heard some positive news and you heard some negative news. Your job is going to be figure out how that's going to impact your trading and the size of the thing. Are they lying to me? Are these numbers real numbers? Right? We all work on the premise that the news lies, right? And if the news lie to us, if the news people lie to us, when they tell us that it's great, we know that it's terrible. When they tell us that it's terrible, we know that it must be getting great, right? Because they want us to do opposite of what they're doing. Just think about if you had all the money and all the power, and you could manipulate people to your will and bend them to your might, right? What would you do? Do you want them trading alongside you, or do you want them trading opposite of you? Because this is a zero-sum game. In order for you to win your money, somebody has to lose on the other side of the trade, right? So if I'm giving you all the correct information, then you're trading with me, right? You're not following me, you're trading right there with me, right? And somebody has to lose. So I can't really give you all that I have that's correct and accurate, because then you wouldn't lose. Somebody has to lose to pay for all these mansions and all these things that they have. So just from the aspect of knowing that it's a zero-sum game and they have to win, that means that you have to lose. And they're going to manipulate whatever they need to manipulate to make sure you are one step behind, one step more confused, and that they have the edge so they can take your money. So when you see these news events happening, you're going to see the Fed talking about things like we're dumping in a $2 trillion package. It went from 50 billion to 500 billion. No, I think it went from 50 billion to 85 billion, something like that. I'm sorry, I got that wrong. It was 8.5 billion to 50 to 500 billion. Then it went from 5 billion to $1 trillion. And then it went from $1 trillion to $2 trillion, right? At the same time, that's all positive, right? But at the same time, on the other side of that, you got new cases popping up. You got them saying it's going to be worse than expected. It's going to last through the summer. Schools are shutting down. You can't go to work. You can't go to these different places and restaurants. So the job here is, what is the most impactful thing that's going to affect your trading? And you got to remember that when investors get scared, they sell. They get nervous, right? Just like you would, right? Just like any of us would. If we get scared, be like, man, you know, like what I think Jessica thing is, now that ain't G. That's a Zia. All right. But I think Zia's thing is, I don't know if you all know Zia, but she's like, if you move, I move, right? And we play follow the leader. We don't play leapfrog. We don't try to get in front of the guy or the girl, right? We don't get in front of them. We follow the leader. If they scared, we scared. If they happy, we happy, right? So if they're all scared, why are we jumping for joy? We should be running for the hills. We should be scared too, because we're playing follow the leader, right? So when they're telling you that this stuff is all great, we got this $1 trillion stimulus package, $2 trillion stimulus package, and don't be fooled by that. It's not a stimulus package; it's a spending package. It's not going to stimulate a daggone thing, right? It's just going to be a bunch of money given away so people can feel great, so they can start spending on the other side and try to stop the economy from falling. Because it's not this problem is not a financial problem, right? It's a health problem, right? It exacerbates the financial problem that we already had, which was the market was already too hot and overextended, right? So the thing that we're looking for is one of the things that we're looking for is how do we determine what's going to happen when the markets open on Monday? We've been shut down all week, right? And every day you hear somebody else coming out and saying, we're shutting this down, we're shutting that down, you can't go here, you can't go there, we're running out of supplies. The medical professionals are scared, they're getting sick. And these are people who don't get scared because they deal with this stuff every day. They're scared and terrified. Why are they scared and terrified? Because they don't have the protective gear that they need to protect themselves and their families. So that causes a level of hesitation, right? So all of this stuff goes into your analysis of fundamentals, right? How does this affect my trading? What's the biggest thing that's happening? Regardless of what they say, the biggest thing that's happening right now is that we get new cases, and those cases are going to continue to rise. And as long as those cases continue to rise, it doesn't matter how much money they throw at it. The market is going to continue to drop. Any questions, comments, concerns?
Mr. Tony, can I ask you a question?
Yeah, it's me anything you like.
I guess my question is, like, if I were, what I did Sunday night, I Googled the Dow to see, like, how it was going to start out. And I saw that the futures were down, I think, like 5% to the point where they limited already. Now, how does that affect how it might open up on Monday when we look at futures?
Some people look at, okay, first of all, what you see in the futures market, all right, you have to understand is not really what's happening in the Dow. Right? That's not the Dow. That's what they think the Dow is going to do, right? When it opens up. You'll hear them say stuff like, we expect the Dow to open up lower. Well, if this futures market was the Dow, they already tell you what it's going to do, right? It's already doing it. But they'll say things like the Dow is going to open 500 points lower, right? I don't really like playing I really don't like playing that game, right? Because that game that you're playing there is really, when you're dealing with CFDs, when you're dealing with futures and things like that, you're really dealing with you and your broker, right? Excuse me. And that broker has a lot of leeway on what he can do. Open the spread, lower the spread, play with the price, don't have to execute the trades right away. You know, he got a certain amount of things that he can do, right? So I don't really like playing that futures game before the market opens, right? Because they'll fake you out on one way, on one thing, and have you go in a different direction, do a misdirection on it. And what I noticed, and I don't have any concrete numbers of this because I just kind of haphazardly and just glanced at it from time to time. But what I've been noticing is when they stop this market, say I'm gonna limit down, say we're in the futures market, and they limited it down 5%. It opened up yesterday and it went down immediately 5%. Right? When it opened up this morning, right? Was it up or down? Did you pay attention?
Well, I saw when it opened up, you had a spike up on it, and that's what I marked out by technical. But I was just saying by like fundamental, like how would that come into play?
How would what come to play? I don't understand your question.
I mean, maybe the better way to word it is, and I think you answer that, where the futures may not have any impact on what it actually is. And then, like, when it opened up, to me, it opened up strong and then it went back down. And that's what I marked out by technicals. But I was just wondering, how did fundamentals come into play today?
The fundamentals come into play when you get little fuel and cash injections, or you get positive interest rate news. That's always, let me take that back. Most of the time, it's going to give you a little boost in your price, right? Because people feel good the government is doing something. Somebody is doing something. They're taking the thing by the reins and they're doing something. But when you come out and you got, 20,000, 15,000 cases on Friday, and you open up on Monday, there's 30,000 cases, 20,000, 30,000 new cases somewhere. Yeah, I got that little bump up in my price. But the overarching sentiment, the overarching news is still the coronavirus. It's still the recession. That's the coronavirus bringing about a recession. So yeah, I got an interest rate bump, but you remember, interest rate is not bigger than a recession, right? A global recession trumps interest rate every day. Yeah, you're going to get a temporary pullback on the minor trend, but the overall major trend is still going bearish. And they're just trying to slow it down and keep it from free falling, or trying to limit the damage as much as possible to get through it as much as possible, right? And by having all of us stay home and stopping the virus faster brings about a faster recovery because it reduces the numbers, reduces the spread of this what they call virus, right? So the fundamental come into play because even though they got this cash infusion, they got this little interest rate bump, they got whatever they got, this little plan that they're working out that's not even finalized yet. People feel good because somebody's doing something. People want the government to do something. And when they feel like they're doing something, they get a little excited. But the big boys know this market has still got a lot of downside, right? And it's going to continue to have a lot of downside until these numbers start to peak and they start to level off and reverse. That's how the fundamentals play into it. Don't get tricked into thinking because you got a little interest rate boost or you got a little cash infusion, a little $2 trillion infusion, right? That this is going to change this market around. It's not.
Yeah, that's what I believed this morning, and I mean, I appreciate that, Jessica. I think she put like a link in her chat where it shows like the number of cases, and I guess my perspective that I was thinking of was like when President Trump came out and said, "Oh, we're doing more testing, like we're getting more equipment for testing." I was like, "Well, that's just going to increase the cases, which is not good." And I guess that's what you're going into, so I appreciate that.
Yeah.
I have a question kind of to piggyback on that. Like, I had the same type of question. Like when Boeing made that announcement today about halting work in their factories, I kind of expected the Dow to fall a little faster, but it kind of didn't move that much. So was it already kind of factored in because of the coronavirus? If that makes sense.
It could have already been factored in because of corona, but it also could have been factored in because Boeing stock is already greatly depressed, right? Boeing, a few months ago, Boeing was traded over $300. And last week it hit like $89. And this week it's like 90 something dollars, right? So Boeing's brand is already damaged. And it could be a situation, we don't know yet, where they may let Boeing die, right? They let Lehman Brothers die. They could let Boeing die too. And maybe Boeing is on the chopping block or Lockheed Martin to pick them up, or Northrop Grumman to pick them up, or maybe they divide it up into maybe that Boeing get divided up.
Or
Hey,
nationalize
Boeing
it.
has, huh?
Or nationalize it.
They're not going to nationalize air travel. They're not going to do that. I don't believe they're going to do that. I mean, they could, but I mean, you would have so much resistance to that, it'd be unbelievable. The more likely play would be that the other companies break them up and suck them up. And there's no company right now, for example, that's big enough to take on Boeing until they take on Boeing. Then they'll be big enough, right? Boeing has patents, copyrights, trademarks that are very, very valuable, right? They got military secrets. They make all type of military grade equipment, right? So somebody who sucks them up, like Lockheed Martin, would be a good play, or maybe Northrop would be a good play. I don't think they would let somebody like an Airbus suck them up because of the secrets, but they would certainly let the other two companies suck them up. Right?
But because it's such a huge part of the Dow, wouldn't the Dow be more affected by that?
Yeah, probably. But the Dow is already greatly depressed. How much more bad news can it take, right? I think it can take quite a bit, honestly. But this stuff moves in cycles and waves, right? It doesn't go straight down, it doesn't go straight up. And because they're doing something, they're looking into this $1 trillion or $2 trillion plan to do something. People kind of feel a little good about that. They're like, oh, maybe it's not as bad as we think it's going to be. But some of these people are not educated into what's going on. They're not looking into what's going on behind the scenes. You're looking at these, these ETFs, for example. These ETFs are made up of other things. They're made up of other assets, right? So you can buy these ETFs, right? But the underlying asset of it still has to perform, right? If those assets are weak, then the ETF, for example, is going to be. So it's hard to explain it all because it's so much information, and we really don't know how it all fits together. Right? We really don't know how it all fits together and what's going to impact what they're working on that's going to come out tomorrow while we're asleep, or tonight while we're asleep. So we're really just kind of reacting to what they're doing, but we try to have a basic understanding as to this is what's happening overall in the world. This is what's happening inside this country, and this is how it's going to affect the companies and the people within that country. Right? And how it's going to, on a global scale, how it's going to affect the world as a whole. And understanding the fact that most of the world takes their cue from the Federal Reserve, the United States Federal Reserve, gives you an insight as to what the other Federal Reserves are going to do, right? And sometimes, like the other countries, they break away from the Fed or from the United States because there are sometimes appearance of lack of leadership. Not necessarily appearance, but we're going to use that as a good word. The lack of leadership. There's a lack of clarity. So when that happens, the United States does one thing, or the Trump administration does one thing, and the rest of the world does another. But that causes confusion because there's not clarity, there's not unity of thought or action. Great Britain came out with this very aggressive spending package. We don't call it stimulus just for the sake of argument, with this stimulus package, right? But the United States still has yet to approve this. So the lack of leadership and the lack of confusion causes the markets to have mixed signals. Right? It may be good over here for some of these pairs, some of these GDP pairs and things like that, but it might be bad for other things, other assets, other pairs. That makes sense?
Yes, thank you.
Yes.
Anybody else?
Didn't the Federal Reserve or the Central Bank of Japan make the interest rates negative, and then end up picking up their own stocks, their own Japanese stocks, so that the market wouldn't crash? And do you expect that to happen here in the US?
Man, you asked a hard question. I'm not aware that the Bank of Japan did that. But negative interest rates, by and large, for the United States is probably a bad idea, right? The Federal Reserve right now is just about out of books. They came out today or even yesterday, they're talking about we're going to do daily cash infusions of $1 trillion. I think that's what they said. Somebody correct me if I'm wrong. But I thought I read where they said they're going to do daily cash infusions for an unlimited number of months, unlimited period of time for $1 trillion a day. Where are they getting this $1 trillion a day? Right? Now, think about this long term, right? You do this for 30 days. That's $30 trillion. Just for 30 days. The entire US economy is only worth about $16 trillion. Right? So where are they going to get this $30 trillion? Right? And they put this money in the world, right, to try to stabilize the economy. Right? This is when we have to get into things like hyperinflation, things like deflation, hyperinflation, the velocity of money, right? How the velocity of money, basically, just for a quick history lesson, is just how quickly money changes hands, how often money changes hands, right? If I got $1 and I give it, not on mute. All right. So if we got $1 and I give it to Jessica, and Jessica turns around and she gives it to Sophie, and Sophie turns around and she gives it to Timon, right? Well, that $1 is about $3 worth of goods, right? So it went from me to Jessica to Sophie to Timon, right? And each one of us bought something for $1. Well, so now we got $3 worth of goods off of that same dollar. And just imagine they put $30 trillion in the market. And people go out and spend this $30 trillion. So they got all these goods and services that's been bought with the same $30 trillion. Right? Some people are going to save it, some people are going to invest it, some people are going to buy gold, silver, whatever. They're going to do whatever they're going to do with it, right? But at some point, the Federal Reserve has to take that money back out of the market, right? Okay, say people took that $30 trillion and did spend it because they just said, okay, the cash infusion, the bank gave me some money, I did what I was going to do, I'm going to hold it, right? Then the economy start looking good. It start looking great. The blue skies start coming back out. The birds are chirping, right? The grass is all green, the flowers coming up. And that $30 trillion come rushing back into the market. What do you think is going to happen?
Can't find my slider.
I didn't hear you. Say that again?
They're going to get their money back.
They're going to get it back, but they may not want what they get. What they're going to get is inflation. And they're probably going to get runaway inflation, which is hyperinflation. Hyperinflation is terrible, right? When you got a market like this, to back up just a little bit, again, then get into hyperinflation. And this is how paying attention to the news starts to make sense, right? If you understand that in this economy, when the economy starts to slow down, you go through a period of deflation, right? Everything starts to lose value. We always talk about inflation, but we need to also start to talk about deflation, right? When things start to slow down and things start to lose value. And then when things start to lose value, what does the Fed do? They lower interest rate, they pump money into the market, they prop up banks, they do cash infusions. They do all of these things to try to stimulate the economy because they want to keep the good times rolling. But sometimes the thing is so big, they can't keep it rolling with the things that they have, but they only have a few tools. Cash infusion, they can do modifications of debt. They can lower the interest rates. They can drop them to zero. They only have a few items that they can use, right? When they fire off all those bullets, there's no more bullets to fire, right? They empty. The market has to do what it has to do. And if you understand that they're putting all this money into the market, and you know that the market is in a period of deflation, and you know that at some point, this money has to be spent and come back into the market, the rate at which it comes back is going to determine whether we're going to have runaway inflation or not. If we got runaway inflation, that's going to totally devalue the currency. And then when you devalue that currency, what's going to become the thing that people turn towards? Anybody know?
Bitcoin.
Say that again?
Bitcoin.
Bitcoin? That's good. What else?
Gold.
Gold,
Gold,
silver.
gold, silver, platinum, palladium, right? They're going to turn towards the metals, right? They're going to turn towards the yen. The United States is a currency. As a currency, is a safe haven. Simply from the fact that most of the world uses the United States as the currency of first reserve, right? But when that hyperinflation kicks in, right, the value of metals and the value of safe haven assets is going to skyrocket. So it's going to, like it is now, the period of deflation. Check it out. Check it out. Check out what happened. What's happening now to what happened right before the Great Depression. Right? It went through the same type of cycles. The difference is this time it's happening faster. And this time we got international travel, and we got internet, and we got Corona, and we got a trade war, and we got a price war on oil, right? We got people who overextended on credit, no savings. We got a weak job market, right? It's been weak for a long time, right? And people say, well, the job market is strong. Okay, let's look at that. If you look at that and they say, well, the numbers are good, right? They tell you the numbers are good. But when people stop applying for jobs, they stop getting counted in the unemployment rolls. So they don't count those people. They're still unemployed, but they're not counted anymore because they're not actively looking for jobs. So when they say, well, my numbers were down, well, those are the people that they're counting. What about the people that are not counting anymore, that lost jobs last quarter? Right? So you have to sometimes not only look at what they're saying, but look at what they're not saying and understand that just because they're saying that the numbers are down, are they really down? I remember last quarter, you said the numbers were good, and I know it was 50,000 people that couldn't find jobs. But now you're telling me the unemployment numbers are better because you're not counting those 50,000 people. Right? Just like it is with Corona. You tell me the numbers are great. But how many tests have you not run? How many people are you not counting because you want the numbers to be great? Like Trump didn't want that cruise ship to dock because it was in international waters. As soon as it docked in the United States, those people had to be counted as coronavirus people, right? So you keep them at sea, you can't count them because they're international waters. Come to United States waters, they're United States, right? Those go to his count. So understanding what they're doing gives you a bias, gives you an understanding of how this market is potentially going to move. And that's what fundamentals is about. This is what the news is about. Understanding what could potentially happen based on what we know right now and how the other investors are going to respond.
A lot of reading between the lines.
What are they saying? What are they not saying? And then it's a lot of history. I mean, fundamentals takes a lot of reading. It takes a lot of understanding and historical look back, right? What's happening now? How does this market parallel to other markets? What economic indicators are these people saying or firing off that gives them a clue that historically this told me a recession was coming? Because these analysts have been saying a recession was coming for a while, but they just kept the good times rolling. you also got to understand how they build these indexes, right? Right? They put the strongest companies, the strongest players in the index, right? If you put the strongest players at the top, and they're top heavy with strength, is it going to push it down or push it up, right? If these players are doing great, it's going to push that index up. If these players are doing bad, push the index up. But they're the top 800-pound gorillas. So when you understand how they build these indexes with the strongest players, and they keep putting these strong players in there, you know, if Boeing falls off, they'll put another strong player in this place because they want the good times to keep going, right? That's the way it works. There it goes.
So what would you say would be the next best step for the United States to take towards the recession and the coronavirus in order to settle the stock market back out the way it is?
I don't think there's much anything they can do, personally, right? I mean, like I said, I'm not an analyst or anything, right? But just looking back at what has happened in the past and how they have done things in the past. And, you know, when people come out and tell when the good times are rolling, and you got one somebody or two somebody, a handful of them, right? And they come out and say, "Look, the sky is ready to fall." Those people are shunned and laughed at until the sky actually falls. Like, look at the movie The Big Short. When that guy shorted the market, everybody laughed at him because the good times were rolling. But he looked at the numbers, and he looked at the underlying assets that were supporting all of the loans and all of the derivative swaps and all of the industry, the mortgages and all that crap, right? He looked at all of that. And he looked at the data, and the data said the market was weak. Now, you can tell me anything you want. When I crunch that number, right, and that number comes back and says, man, there's no way this thing should be going up. Who you gonna believe? You gonna believe the guy who crunched the big counter who crunched the numbers, or some guy down here on Wall Street trying to take your money, right? More people gonna believe the guy on Wall Street because they don't think the thing is going to fall. But it's propped up on nothing. It's propped up on empty promises. The same thing that happened in 2008 is about to happen now. The real estate market is overextended, right? It's in a bubble. Back in 2008, I remember when .com crashed, right? When the .com crashed, they said then the next bubble was the real estate bubble, right? And when the real estate bubble came, they said the next bubble after this was the credit bubble. Well, what we got now? More Americans have debt than anything else. We're in a debt society, right? They got debt, they got student loans, they got mortgages they can't afford, they got cars, people buying these expensive cars they can't pay for. All of it is on credit. Buy now, pay later. Same thing happened in the Great Depression. Buy now, pay for it later. The only problem is when the banks and things get in trouble, later is now. They call that stuff in. People think, okay, people who have mortgages, for example, they think that you got 3 months before you pay your mortgage, before the bank come after you. That's false thinking. They give you 3 months, but they come after you after the first 30 days. But they give you time to work it out because they really don't want that house back. They really just want the money. The banks are not in the house business. The banks are in the money business. They'll take the house, but we really want the cash, right? Because a house sitting on their books is an asset they can't borrow against. They can't loan against, right? You got to understand how those banks work with their lending rates, their deposit rates, right? They have to have a certain amount on cash for the money that they loan out. Understanding how all of that works and understanding how the fundamentals affect that and why the banks right now are trying to use the coronavirus as a reason for more deregulation of the banks so they can go back to doing what they did in 2008 before the market died is very important. Because if they get their way, they're going to be able to chop up these loans like they did back then, which caused the first crash. And now they're even bigger than they were back then. It was too steep to fail then. So these fundamentals mean something. And then once you get away from that, then you get into your technical analysis. Okay, I know the thing is falling. I know I have a belief that based on my research, this thing is going to go this way. Where's my entry? How can I get into this thing and not get stopped out? How can I take advantage of this? And I know it's a good chance it could whipsaw, right? And hit my losses, my stop losses, take me out if I can never take the profit. You know the thing is going down, but it could gap up, it could gap down, it could whipsaw, it could range, it could stop for the day. 15 minutes, hit one of those limit down circuit breaker zones. They could. My theory is that they take, when those circuit breakers happen, my theory is they take those buy orders and they push them to the top. Because if you look at what happens after those circuit breakers, I want you all to check this out with me, because I'm just one set of eyes, right? And I may be looking at something through an old twisted eye, right? When they stop those things at the circuit breaker, see if that thing reverses when it opens back up. My theory is, and I can't prove it, and I'm never going to be able to prove it, but what I think I saw was when this circuit breaker happens and they have a chance to cool down the market and stop all the trading, why would it not just sort those orders to the top? Why would not just put those buy orders to the top? Why wouldn't I put in buy orders, real or fake, to make people think the thing is going back the other way? So you will stop your sell position and get into a buy position. Why wouldn't I do that if I had the power to do it? You think these billionaires and trillionaires will lose their money? No, they want to stop this thing. Let's put a couple orders in there, make them go the other way. That's what I'm seeing. And from a technological perspective, being a programmer, it's very easy to do. I mean, it wouldn't take me 2 lines of code to do that, right? And it's done. And everybody's going the opposite way. All right, I'm gonna pause right there. That was a lot of information I shot out there. It might not have made any sense to anybody.
That was good, though.
Anybody got any questions?
We just thank you for introducing us to this conversation.
Oh, you're welcome. You're welcome. One of the things I really want you all to do, right? In terms of fundamentals, and I had a video. It's a. Let me see if I can find it real quick. It was a video on the Great Depression, the beginning of the Great Depression, right? What happened then, and what's happening now that looks like what happened then, right? I'm gonna see if I can get it in my watch list, my videos. I don't know how to use YouTube that well, but let me see if I can find it here. Here it is. The Great Depression. I got 2 videos, right? I'm gonna put them in a group real quick.
If you're the type of trader who has done everything out.
I'm sorry, I didn't mean to start that. All right, where's the chat room? Check out this video right here. All right. I'm gonna give you another one. That's one. I can't remember which order I want you to watch them in, but just watch both of them. All right. And these videos, one of them is a guy explaining what happened, and the other is actually the beginning of the Great Depression. Can't remember which one it is now. All right. But look at what happened then and how bad things could get. I'm not trying to gloom and doom and scare anybody, but this is the reality of the life that we're living right now. And I want you all to be prepared, right? And when they're talking about people making a run on things, they're making a run on the banks, they're making a run on grocery stores and toilet paper and all of those stuff. Right?
Where did you put the? I don't see it in the chat. Do y'all see it?
Oh
no.
Right.
Yeah, I don't see it in the chat.
I guess Nathan would. Hold on, give me a minute.
Did you send it direct? Or what's the name of it? I'll just pull it up on YouTube real quick.
I put it under Nathan. I'm sorry. Nathan got him. You get that one? I don't know why Nathan came up on my list, but Nathan has it. You got that one? It's two of them.
Yeah.
Yes.
Okay, there you go. Sorry about that.
No, you're fine.
But what was I saying? Yeah. I don't even know about that.
You were talking about the video.
Oh, yeah.
Yeah.
Look at those videos, and you're going to start to see some parallels about what happened then and what's happening now, right? And like I said, I'm not trying to doom and gloom everybody and scare people, but you kind of really need to know. And in the bear market, cash is always king, right? If you got cash, go get it, right? How much you get, I don't know. 20, 25%, leave it in the bank, keep rolling, and the rest of it, hold it in your pockets, throw it in a hole somewhere, right? But if the bank shut down, you can't get your money. It's really just that simple. If they close the Bank of America tomorrow, you cannot get your money. Nobody to call, right? So in the bear market, when things are falling like this, cash is king. There was a bank in California that I used to do business with called IndyMac Bank. When they got in trouble, I think it was early 2000s. I remember this gentleman. He had $400,000. He was an older gentleman. He was getting ready to retire. That's when the FDIC was like $100,000. They closed their doors with that man's $400,000 in there. When they opened back up, they gave him a check for $100,000. That's all he was insured for. Somebody got that man 300 G's, right? But he had to wait to get his money. Now the man can't retire because they don't take all of his money. And people don't think that these banks will close up. They will close up. A large cap stock will become a small cap stock. You don't think it would happen? Look at JCPenney. JCPenney used to be a large cap stock. Look at Kmart. They're closing those up, right? Lowe's shut all these stores, and these large companies will go to zero. And people are saying, okay, buy the dips. You better be careful buying the dips in this market unless you really, really know what you're doing, right? Or you got a whole bunch of money you can play with, right? You can buy those dips, but you better understand how this thing works. You understand that you coming up on a limit down, that you're coming up on a big push to the downside because some news came out right before you got into the market and you wasn't aware of, or it came out last night and you trying to play the futures. And you don't understand that we had 3,000 extra cases of corona right next door to you. You better understand that, because that's going to affect what that market does when it opens. The Dow says it's going to open positive, but if those cases, or if that news is bad enough, it's going to go against you.
What's it, Tony?
It's like, huh?
Real quick. So as far as like fundamentals go in news, what do you recommend? Do we like wait for news to like drop and then like go in for your trade, or like do you wait to see like how the market reacts to that in like a sentiment kind of way before you would enter that trade, if that makes sense?
Yeah. You're talking about timing. Me personally, let me tell you what I do. Now, it's really going to come down really to what you're comfortable. And it's going to come down to whether you're a weak holder or a strong holder, right? If you're a weak holder dealing with a small account, then you're going to trade differently than somebody dealing with $1 million account as a strong holder, right? So they may be able to get in right away because they got more resources. So that changes how you trade. We all had $10 million and the market was dropping. We were like, man, I know it's going to drop today. It's going to drop tomorrow. It's going to drop the next day. I'm going to get in now and just hold it. But if you got $1,000, you're trying to get optimal entry. You're trying to nail it because you only got $1,000. So depending on what that news does, one of the first things that you should understand when you analyze the fundamentals is what do I think this is going to do? How do I think this is going to impact the market? If you hear that they got 30,000 cases, you're going long or short, right? That's what you should be thinking. What you should be thinking about.
Can you repeat that example? I didn't hear you.
If they have 30,000 new cases tonight,
Mm-hmm.
right? And everybody, you know, we all sleep, we wake up in the morning, they got 30,000 new cases. Are you going long or short tomorrow?
Short.
Going short. Why? Because you anticipate that the market sentiment is going to be so bad that they're going to go short. Now, say, for example, they also come out with trying to combat that, a $5 trillion package instead of a $2 trillion package. And that throws a wrinkle into the analysis, right? Because now you got on one hand negative news, and on the other hand positive news. This is the tricky thing about fundamentals. Which one of these things is are investors going to react to? It's a couple. It's a couple. Yeah, it's tricky, huh? Like, because here's the thing, right? If I said I was putting in $2 trillion, on the surface that looks great. The government is doing something. But if I come back then and say I'm gonna put in $5 trillion, you would think that the market will move positively, right? But sometimes it moves negatively because now people are thinking, oh, dang, this is worse than I thought. Right? And that's the tricky thing about fundamentals, because I done got caught in a trade where I knew I was buying gold. I was shorting gold. No, let me see. I was long on gold. I was long on gold because the dollar was dropping, US 30 was falling, and gold did not move. I'm steady pumping money. Oh, I know this thing about to run through the sky. Oh, I'm going long. It's a safe haven asset. It's about to bust 1,600. It's going, but it didn't move. Right? I ended up losing that day. I was big. So, because my bias was gold is going up. I saw all this stuff that was happening in the news, and my bias was this, and I'm putting in 3 and 4 positions. I'm over leveraged. I'm getting ready to kill the market. I'm getting ready to kill the game. Right? I'm ready done. I'm gonna retire. Give me a yacht. I'm done. Right? And the thing didn't move. And when it finally did start to move, by the time it started to move, it started going against me. Right? And that's when I started looking at a couple of different things. Why didn't it move? Why didn't it do what I thought it was going to do? Right? That's when I started looking at correlations between assets. Right? How closely correlated are these assets to one? Right? And I found out that gold and the dollar and the gold and the Dow are not a one-to-one correlation. Just because one moves doesn't mean the other thing is going to move right now. It could take it days to move. It could take it weeks to move. And the correlation changes every day. Today it might be 80% correlated. Tomorrow it might be 60. Right? So that's the funny thing about fundamentals, right? The funny thing about fundamentals, right? You have to look at it, understand what's happening, and then wait to see what the reaction is. Now, you don't have to jump in early, so there's plenty of opportunities for you to wait, right? And you say, okay, this is what I expect. Now, what are my technicals telling me? All the stuff that Jessica and y'all been doing, the technical analysis. What is my technicals telling me? I understand it's going short. I believe it ain't coming back. I believe that if it does come back, it's going to bounce off to 50, or it's going to bounce off to 200, or it's not going to reverse on. I believe that because of all the negative sentiment. So where's my entry? Where's my optimal entry on my technicals? That's how you put those two things together. What do I think is going to happen? When it starts to happen, where do I get in? Where do I get out? How do I manage my position? Right?
Okay, so then second follow-up, because you mentioned that the key to understanding fundamentals is understanding the things that are said, the things that are not said, and reading in between the lines. Then, like, what pointers for somebody that doesn't really know much of fundamentals? Like, then what pointers would you like say to look out for within like reading in between those lines to really like create like maybe like a basic foundation per se?
Oh, that's a hard one right there.
Right.
That's a hard one.
You gotta read because
Yeah.
like literally is no way for somebody to truly teach you everything about fundamentals. Like it's like self-knowledge of you just putting in the time. Like I even learned that. Like somebody could tell you something all day long, but understanding like how these different things correlate, like he said, where you gotta go back in time and go back in history. Like when he said find what you trade and then find those commodities or how literally the commodities affect the asset that you're trading. That makes sense.
Mm-hmm.
But it's a lot. Like it's a lot. It's a lot.
Any recommended books, Jess?
Tony?
Or Tony?
Like it's a lot. Like I literally the fundamentals. Like remember I told y'all about that year-long course. Like it's a lot. It's a lot. Like it is a lot. Like it's no way to just like when he said it's not an easy answer. Like it really is a lot. It's literally like studying the economy and like really seeing like when he talk about like Fed rate cuts and all that different stuff, like it's literally studying the economy.
Yes, it's macroeconomics, right? But here's some things. Here's some general things that you always need to look out for, right? Whenever the Fed speaks, whenever Jerome Powell or whoever the Federal Reserve Chairman speaks, pay attention to that because that moves the market. When they have FOMC meetings, Federal Open Market Committee meetings, pay attention to what they say, right? Know who the players are on the Federal Reserve Board, right? Know what they believe.
Well, can you slow down so I can write this out for them? Okay, FOMC moves.
I'm sorry, I be going in, I be forgetting.
You going too fast. I'm trying to write this down for them. So FOMC moves, know the players on the what?
Know the players on the Federal Reserve Board, right?
Okay.
Right. I'm gonna give you two terms, dovish and hawkish. Right? DVISH, dovish, and hawkish. We talked about this last week. Right? Know if they're dovish or hawkish. Go to Investopedia, read up on it. Right? Because if you know if they have a dovish sentiment or a hawkish sentiment, they're either lax on interest rates or they're aggressive on interest rates. And then they flip to the other side that says something. Right? If I'm like, no, let interest rates stay the way they are, the economy is doing great, and then I flip and say, hold on, let's raise interest rates and slow it down. That should tell you something, right? It should tell you that the easygoing guy is now an aggressive guy, right? Or an aggressive guy is the easygoing guy, right? It means something. They didn't, they may not have had the microphone in their hand, but their vote means something. They voted a different way, right? Or if Jerome Powell gets up there and he says something like, well, we're going to leave interest rates unchanged, but the people were expecting interest rates to fall, that does something to the market. Because now the investors are confused, or they may have thought the economy was going to get stimulated, but the Fed decided it's good enough. That could cause the market to fall. Just the opposite could happen. They could come out and raise the rates, slow the economy down, right? Everybody else might have thought they was going to leave them unchanged. let things be what they are. But apparently the Fed looks out and they say, okay, the thing is overheated. Let's slow it down because we see inflation coming. Well, the investors might not like that, right? So understanding what the overall market sentiment is, and then understanding what the decision makers and the policy makers are saying and doing makes a big difference, right? If you and I, Sophie, were going shopping, and I say, hey, Sophie, I'm gonna give you $100 to go shopping. But when we get there, I'm gonna say, I'm gonna give you 50. That makes you feel good or bad, right?
Bad.
You'll feel a little bummed out, like, man, what happened to the 100? I came out here waiting for $100. So you're gonna start to do it. You're gonna start to buy different things. You may not buy the fancy stuff. You might go get the $3 shoe. You only got $50, right? So depends on the sentiment. Your sentiment was, I'm going to go spend this $100. I'm gonna have a great time. Then I get there and say, oh, things ain't that great, Sophie. I only can get 50. Your sentiment changed a little bit, right? Well, that's what happened to all the other investors too. They sentiment changes. So they start to do things differently. And that's what fundamentals is about. It's about trying to get an edge on what you think is about to happen, waiting for it to unfold in your chart, and then taking advantage of it. Anybody else?
So what do you do on a daily, like what resources do you look at, and then what do you do weekly?
Go ahead, I'm sorry. Go ahead, I didn't hear your question. Finish your question.
So when you wake up in the morning, what are the resources or the sources that you're looking at in the morning? Like what websites do you read aside from the ones that you pointed out? And then weekly, what are you looking at?
Okay. When I wake up in the morning, the things I look at is a cup of coffee and a donut, right? That's a guy's honest truth. I need me a cup of coffee. But I don't really particularly say I look at anything when I wake up in the morning because I look at things all day. Right? It's not one thing that I go to and say, okay, I got to look at this and say, this is my thing. I'm constantly looking at CNBC. I'm constantly looking at investing.com. I'm constantly looking at Yahoo Finance. You know, I'm constantly getting news fed to me. Just about 24 hours a day, right? If I get up in the middle of the night to go take a drink of water, I take my phone and I take a glance and see what happened in China, or what happened in Australia, or what happened in the United States, right? So it's not one thing that I look at per se, like other people. I'm not a news junkie like that. I look at stuff as it comes to me, and I evaluate when it comes. But I also understand I don't have to look at everything because I have a general sentiment and a general bias as to where we are and understanding of where we are. So when they come out and say, well, we got a $2 trillion package, well, I knew they was going to do that. I knew they was going to do that because I know they got to do something, right? I didn't know what they were going to do. I knew they was going to put some money in. It was just a matter of time, right? Or if I know that the economy is getting slow, I know they're going to cut rates. The question is by how much. It's not a matter of when or if. It's a matter of when and by how much. Because you know they're trying to keep the good times rolling. So with the understanding of, okay, the economy is on fire. There's no reason to lower rates. I'm going to leave them alone. Economy starts to slow down. I want to keep the good times rolling. Low interest rates stimulate the economy because of cheap cash. Okay, I know they're going to do something. But I also know they're not going to be too aggressive because they only got so many bullets and so many times they can lower rates, right? They don't want to lower rates too fast, too often, right? But they got to do something. They don't want to put too much money in the market, but they got to do something to show that they are in control when they're not, to show that the market is stable when it isn't, to show that good times are going when they're about to fall, right? They got to do something. So when you understand that they have to do something, what is it they have to do? If the thing starts to pull back, you know they're trying to keep it going. If the thing is going too far, too fast, they got to pull it back, right? They have to. They can't let inflation get out of control. The Fed's charter is to control inflation, monetary policy, and interest rates, and cash flow, liquidity, right? That's what they do. Keep the jobs coming, keep the money flowing, keep everything rolling. That's their job. And they look out, they put in all of this data, and they say, okay, from all of this data all over the world, from all these different Federal Reserves and central banks and all these type of things, put it together, what do we see? Oh, it's slowing down over here in Texas. So the oil, they're not pumping enough oil over there. Or they're coming down here out of New York where we get this material. The jobs are slowing down up there. So they get all this data from around the country, and they analyze and say, oh, we see things are slowing down over here in the Midwest. We see things are slowing down here on the East. Hasn't affected the West yet. It's still booming over there, but we see it coming that way. It went to New York. It came to Florida. It went on over to Tennessee. It's over into Missouri. It's going that way. So it's eventually going to have an impact somewhere else. They take in all this data and they make adjustments to what they do. Right? Understanding that they have to make those adjustments puts you in a better position to a person who doesn't know they have to make that adjustment. That gives you an edge. So if you're on the opposite side of a trade with that person in a zero-sum game, you got an advantage because you understood that in New York, they got 3,000 new cases, and the other guy over here didn't see the news. He's just trading off of technicals. He get ready to go long, and you know for a fact it's going short. You know it down in your soul is going short, right? Just wait. And that's your edge because you got the fundamentals to understand this is what's about to happen. Where's my interest? So you take your news wherever you get it from. You can get your news off of Twitter. You can get your news off of Facebook. Social media is a great source. Get your news from your friends, right? You guys, it's 100 people in this group. Feed news to each other. Right? I saw this happen. I saw that happen. Talk about it. What do you think is going to happen with this? How do you think this is going to affect the market? It's 100 people here, right? I mean, you might not want to do it in Jessica's group because she might be inundated with fees already. You might want to start something separate, but just start sharing data with each other. Hey, I saw this on YouTube. What you think about this? That's how you start to build. That's how you start to build your fundamental, your fundamental clout, your fundamental knowledge. You share news with each other. It's 100 people. Somebody's out here watching news sometime a day while you sleeping, and these are your people. People that you come to class with every week. Talk to these people. Talk to everybody here. That's your news source. Somebody's on Twitter. Somebody saw something on YouTube. I got those videos from somebody else. I probably gave it to you. I wasn't looking for no depression videos. That's how you do it. And you say, oh, this is what's happening now. I see the parallel. Who was there listening then? Who was not listening now? Same thing. You put water in the glass. You become the glass, right? That's Bruce Lee right there. Becomes the cup. Right? It's gonna take the shape of whatever you put it in. If it's the same thing, it's gonna be the same thing in the future. All right, y'all. I think I wore y'all out.
No, you haven't.
I do have one question for you. What would be a book to recommend to get into this? I go on Khan Academy and I look up. They have fundamentals on Khan Academy, but a book that we start us off with, something soft, open us up to the world of this information.
Man, I don't have any books ready. I don't have any fundamental books ready, anything like that. I can't say I read a book on fundamentals. Really, I mean, most of the books that I read have been technical books or mindset books, right? I can't remember one that I read on fundamentals. I don't. It's. I mean, the fundamentals is like news.
So just start watching a bunch of news and correlating with the market.
Yeah.
Okay.
Yeah, let's just research. I don't know if you're gonna find a book on fundamentals. If you find one, you let me know. I haven't found one. I haven't looked for one really.
Hey Brooks. Hey, good night, sir. Hello?
Yes, I'm here.
All right. I have a question for you. So, just now while you're speaking, you're saying that after a while, when they continue propping up the US dollar and they can't prop it up no more, where do you think they will get the gold from? Because remember, before the 70s, the gold used to back the US dollar, and then after they take it off. But where do you think they will get the gold to prop back up the dollar itself?
I didn't get the last thing you said. Well, I think they're gonna get what?
Where do you think they would get the gold, the metal
The
gold,
gold,
to prop the dollar?
to prop it all up. Man.
They get back the gold standard itself.
I don't know, brother.
But but from your experience and what you're seeing with currently the markets, do you think that will happen very sooner than later?
I can't call that, man. I really can't. I mean, everybody wants to know when. If we all had a crystal ball right there, we wouldn't be trading. We would be done already. Right? I mean, there's no magic answer to that. There's no magic bullet for that answer to that question. I don't know what they're going to do. I don't know when they're going to do it. I mean, and we got to acknowledge the fact that they have superior equipment, they have superior information, and they got a lot more people and resources than we have. So the best that we can hope for is not to beat them and not to be with them. We don't have to be with them. We don't have to trade with the market makers. We don't have to trade with the big hedge funds. What we have to do is follow them, right? Because you're never going to beat them. You know, they got supercomputers, they got all this information, all these people working for them. The best we can do is to follow the leader. If they get scared, we get scared. If they get happy, we get happy, right? If they're moving their money out of stocks, why am I putting my money in stocks? If they're moving the gold and silver, why am I getting out? I mean, you may have a reason to do that. You may have a reason to get out, or you may be a contrarian trader, right? You may have a reason. As long as you understand that reason, great. But to predict where they're going to go and what they're going to do, nobody has an answer to that question. I mean, they got so many tools, and even if it doesn't exist, they can make it up. Like they just made up. They just made up a coronavirus stimulus package, $2 trillion. Just made it up. They just made up the fact that they're going to print $1 trillion a day, and they said the Fed had unlimited money. Since when? When does the Fed have unlimited resources? They're making it up as they go, bro. So I can't give you in good conscience give you an answer to that question that you may try to act on. I mean, you have to dig around and make your best guessing on that. All right, that's the best one I got for you.
But recently I was doing some research, right? What I found out is that I was looking at the richest organizations in the world, right? I know like the Jews and them, they have like a certain amount of gold, right? And which they can use to prop up the dollar. But what I found out, right? I don't know if it's fake, but what I found out is that in Italy, in Rome, the Roman Catholic Church has a vast number of tonnage of gold. But I don't know if they might use it to prop back up the dollar itself.
I don't know, brother. I really don't. I don't know. I don't know how to answer your question.
But anyhow you take it, from what I'm seeing, the US dollar is about to crash.
Yes, the dollar, the US dollar has been weak for a very, very long time, right? And they have been propping it up. You remember last quarter, maybe last summer even, they were talking about it's the greatest market of all time. Right? Do y'all remember that?
Yep.
And the good times are going to continue to roll, right? But did you pay attention to the fact that the banks ran out of money? They had a liquidity issue, right? Especially around tax time. They were talking about where they couldn't make their quarterly tax payments. So they was talking about the repo market and how they was infusing the repo market with $50 billion a week. But we're in the greatest market of all time, right? So if they're telling you that it's the greatest market of all time, it's probably not the greatest market of all time. And you have to pay attention to what they're doing, not what they're telling you. Because if the dollar was as strong as it is, right, that they say it is, and the economy was just doing this just fantastically wonderful things, why are you cutting interest rates? Trying to stimulate the economy? Well, you cut interest rates to stimulate the economy because it's starting to slow down and get a little weak, right? So you got to pay attention to what they're saying, and if the dollar is doing all these great and wonderful things, then why are you propping it up? Why are you doing QE without calling it QE? You know, why are you giving the banks all this money? Why are you trying to force the banks to loan money to get money back into the economy? Right? Why are you buying up gold? Right? They came out with a thing. I don't have the article, but I thought I read an article yesterday or today that said they are now going to start pricing the value of the dollar with the daily price of gold. What are they doing? Trying to get back on the gold standard? Right? So if a dollar was all this great and wonderful, why you need to prop it up with gold? These are the questions that you have to ask yourself when you see articles like that. Right? You're telling me one thing, you're telling me it's great and wonderful, but then you're propping it up. You're telling me we got all this money, but then the banks run out of cash. You're telling me I can pay my bills, but I missed that payment. Right? How can we be rich and poor at the same time? Either you got the money or you don't. Either you can afford it or you can't. Right? You can't be the richest country in the world and be in debt at the same time. You can't pay it. These are questions that we need to ask ourselves. How can you be rich and poor at the same time? It's a direct contradiction. And when they're telling you this, we're the greatest, strongest economy in the world, but we're 60% overextended in our stocks versus our economy size. How can we be the strongest economy in the world when you don't make anything? When China can weaponize their medicine and say, we're not going to send you coronavirus ingredient, medicine for coronavirus vaccine. We're not going to send you penicillin. We're not going to send you diabetes medicine. We're not going to send you heart medication. You know what I'm saying? How can you depend on your adversary to support you as you punching them in the face? They can weaponize so many things. When China owes 1.5 trillion of your U.S., if they own 1.5 trillion of U.S. currency and decide to dump that into the market, right? To weaken the dollar, they totally can. If they just release 5% of it and kill the dollar, they hold that 1.5 trillion dollar back, right? Because they don't want the dollar to die right now. But what if they did want the dollar to die right now? They dump the cash. Look at the petrodollar. Look at BRICS. Right? I'm sorry, Jess. I know I don't went over.
No, you're fine. I am gonna shut it down at 10 though, but you're fine. Like, go ahead, do whatever.
Okay, I'm sorry. We're gonna make this quick.
You're fine.
Look at BRICS. Right? Look at BRICS. BRICS. I'm not gonna tell you what it stands for. I want you to go look it up. Right? look at their relationship and what they're doing, and understand the companies behind that, the countries behind that, right? And what they're doing to the United States and what they're trying to do. Look at OPEC and OPEC Plus, like we talked about last week. What are they doing to weaken the dollar? What are they doing to kill the United States? Right? But for people who are spiritual and biblical, look at the biblical references. Look at the prophetic references to what's going on. Right? So you start to put these pieces together, right? And it starts to paint a picture. This is what you're telling me. This is what I know to be true, or believe to be true. And this is what you're saying. Where's the contradiction? And how can I take it in? I like that.
Mr. Tony, that was great. Thank you so much. I'm about to shut it off because my eyes are burning and I've been with students all day. But I definitely appreciate it. Everybody say thank you to Mr. Tony.
Thank you.
Thank you so very much. That was very valuable information.
Thank you very
you.
much.
A lot of information.
Yeah, I hope everybody was able to gain knowledge. I hope everybody took notes, especially on the notes that I wrote. Mr. Tony, do you have anything that you want to say?
Yeah, just, don't try to take it in all at once, right? Start where you are. Use what you got. Do what you can, right? This is a marathon, it's not a sprint. You don't have to keep up with somebody else. This is your race. Learn what you can learn as fast as you can learn it. Pay attention to your surroundings, and you will be victorious. Promise you. Take what Jessica's teaching you and put those technically right up under those fundamentals, and you will see your trading change. You all have a good night. Thank you all for listening. And old dude.
Thank you.
And,
Where can we?
Thanks, Jess.
Quick question. Do you have the recording from Saturday?
I do have it. I just been super busy. I'm in the middle of trying to make an app and I have not slept in like 40 hours. So I will send it. Sorry. Thank you for reminding me. Yes, I will send it.
Thank you so very much.
Of course. Bye, you guys.
Bye. Have a good night.
Thank you. Good night.